This tiny piece of plastic accounts for $3 trillion in global debt. And the scary part is, most people using it think they're being smart. I'm responsible, I pay on time, I'm building credit. Ironically, it's often the responsible ones who get trapped for life. Because credit cards weren't built to reward discipline, they were designed to profit off it, disguising debt as freedom, tempting you with perks, while punishing one slip with absurd interest rates. But they weren't always predatory. The first card literally charged nothing. So what changed? And why do millions of smart people still fall for it? We'll get there, but first, we have to rewind to the 1950s, when banks accidentally uncovered a flaw in people's spending habits and realized they could exploit it for ruthless profits. The golden age of post-war America. Jobs were plenty, consumer optimism was sky high, and Americans were ready to spend like never before. Into this scene stepped a small startup called Diners Club in 1950. It wasn't born from a giant bank or flashy tech, just an idea from a businessman named Frank McNamara, who found himself stuck at a restaurant without cash to pay his bill. Frustrated, he imagined a better way to pay. He teamed up with a couple of partners and created the first ever charge card, literally made of cardboard. Instead of carrying cash, cardholders could use it at a handful of local restaurants and settle the tab later. But Diners Club wasn't just about convenience. It was about trust and exclusivity. To be part of the club, you had to be approved and vouched for, which made the card a symbol of status among business professionals and social elites. The card wasn't about borrowing money yet. Users paid their balance in full every month, but it set the stage for something bigger. The idea that plastic could replace cash and spending could become seamless, invisible, and even desirable. The Diners Club model worked so well that by the 1960s, major banks wanted a piece of the action. Bank of America launched the Bank AmeriCard, the great-grandfather of Visa. Here's where it got wild. Bank of America mailed out 60,000 credit cards unsolicited to people who had never asked for them. Just a card in the mail with the message, "Here, spend." Many people, unfamiliar with credit, treated it like free money. They maxed out the cards and then vanished. At first, the banks were scared. Fraud was rampant and many thought the model would fail. But they soon realized something else. People were willing to spend money they didn't actually have. And that willingness? It was pure gold. Rather than stepping back, banks ramped up marketing, lowered credit standards, and flooded the market with cards. Credit cards weren't just a payment tool anymore. They were a way to create a whole new economy of borrowed money. Credit cards didn't just take over the US, their story stretches worldwide. Some countries dodged the worst traps, others walked straight into them. Take the UK for example. Cards came late, but banks jumped in faster in the 60s and 70s. Unlike the US, regulators there played it safer, capping interest rates and demanding clearer fine print. The result? Slower debt explosions and less chaos. Japan's story flips the script. Cards were a status symbol, but a culture value of debt kept growth slow. Even now, many still prefer cash or debit. Then there's India and Brazil. With smartphones booming, credit cards shot up too, but weak rules and low financial know-how left many stuck in high-interest traps. Some countries fought back. South Korea forced cooling off breaks before raising credit limits, giving people a chance to rethink. Different cultures, different rules, but one sneaky trap shows up everywhere: the minimum payments. Imagine this, you owe $5,000 on your card, and your interest rate is 20%. The bank says, no worries, just pay $125 this month. Sounds manageable, right? But here's the catch. If you only pay that minimum every month, it will take you over 2.5 decades to clear the debt. And by the time you do, you'll have paid more than $6,000 just in interest, more than the original amount you borrowed. Minimum payments make debt feel easy to handle, but stretch it into a lifelong burden. Research from MIT reveals that people spend nearly twice as much with cards versus cash. That's because swiping removes what psychologists call the pain of paying. When you hand over cash, that physical exchange triggers a real emotional reaction. You feel the weight of your money leaving your hands. It's a moment of loss, a psychological sting that slows you down and makes you think twice. Swipe a card? That sting disappears. The payment becomes abstract, just numbers on a screen. This disconnect makes spending feel easier, even if you're racking up debt. There's another sneaky mental trick called hyperbolic discounting. This fancy term describes how we tend to prefer smaller, immediate rewards over larger, delayed benefits, even when waiting would be smarter. Think of it like choosing to eat one cookie now instead of waiting to get a whole cake later. The immediate pleasure often wins, even if it hurts us in the long run. Banks exploit this mental loophole with precision. They tweak due dates so you accidentally miss a payment cycle. One late payment and your interest rate can double overnight. Hidden fees pop up like landmines in the fine print. And then there are the credit scoring agencies, the unseen puppeteers who decide how much your mistake will cost you for years by raising your borrowing costs and limiting your options. It's like being stuck in a financial escape room. The exit is hidden behind a brick wall, and you're charged rent every month just to stay trapped. To put the scale of this debt in perspective, the average American household carries about $7,500 in credit card debt. That might not sound like a fortune, but multiply that by over 100 million households, and you're looking at more than $1.3 trillion in the outstanding credit card balances in the US alone. That's more than the entire GDP of countries like Norway or Austria. Imagine a mountain of debt towering over everyday Americans, silently shaping how they live and spend. And it's not just the US. Global credit card debt has now surpassed $3 trillion. That's a number so big it's hard to visualize. To put it simply, it's like every adult on earth owing thousands of dollars in plastic debt. This debt didn't spread evenly either. Young adults and low-income families carry a disproportionate share of the burden. For example, Americans aged 25 to 34 hold the highest average balances, often juggling student loans, rents, and other expenses. Even more alarming, studies show that nearly 60% of credit card users carry a balance month to month, meaning most people never pay off their cards in full. Why does this matter? Because credit card debt doesn't just sit quietly. It accumulates interest at rates often exceeding 20%. That's money flowing out of pockets every month, draining savings and limiting financial freedom. On top of that, many households are just one financial shock away from a crisis. A lost job, medical emergency, or unexpected expense can trigger a downward spiral that's tough to escape. This mountain of debt powers an economy where spending is often fueled not by income, but by borrowing, creating a fragile system that looks healthy on paper, but is vulnerable underneath. By the 1980s, using a credit card meant walking into a store and swiping it on a bulky machine. But fast forward to today, and your spending impulse is faster than your brain can process. With just a tap or a click, you can almost buy anything, from groceries to gadgets, without ever pulling your card out of your wallet. The convenience is intoxicating, but it's also a gateway to deeper debt. Digital payments have doubled credit card transaction volumes in the last decade. And it's not just about speed, it's about removing friction, the little mental pauses that might have once made you think twice. Enter buy now pay later plans, which have exploded among young consumers. These programs let you split purchases into smaller, interest-free chunks, making debt feel invisible. For many, it's the first introduction to borrowing, a smooth, harmless start that quickly builds comfort with carrying balances. But credit card companies don't just sit back. They use AI algorithms to analyze your spending habits, predict exactly how much debt you can carry without defaulting, and nudge you right up to that limit. Picture this, your phone buzzes with an offer just as you're deciding whether to upgrade your headphones. The app knows you can afford it, and it wants you to spend. Behind the scenes, your data is being mined. Every purchase, every swipe, every hesitation, feeding models designed to maximize the amount you borrow and interest you pay. Even if you pay off your balance every month, you might still be losing the game. Those flashy reward programs, points, cashback, air miles, but they are a carefully crafted illusion. Take airline miles, for example. They're often worth far less than you think, inflated like monopoly money. And cashbacks? Usually just a tiny fraction compared to the interest rates people carrying balances pay. You see, you're actually just subsidizing those rewards. How? Stores bake credit card transaction fees around 2 to 3% per sale into product prices. So whether you pay cash, debit or credit, you're paying more to cover those fees. Think you're gaming the banks? Nope, they're gaming all of us. It's the same psychology used in casinos. Slot machines pay you just enough to keep you hooked but never enough for you to walk away a winner. Credit cards works the same way, drip feeding rewards that keep you spending, while the math always tips in the house's favor. Imagine a shopper chasing cashback bonuses, upgrading their card for better perks, and buying things they wouldn't otherwise, all while the system quietly extracts its cut. And the impact doesn't stop there. Some households who pay every bill on time lose thousands of dollars over the years, not in interest, but through inflated prices and hidden fees baked into everyday purchases. Credit card companies aren't just making money from you, they are quietly reshaping the entire economy. In the US, Visa and mastercard control over 80% of card transactions. Every swipe you make funnels a hidden fee, usually 2 to 3% straight into their pockets. That tiny cut is $1 trillion drip that's bleeding the system dry. For you, it's easy to ignore, but for small businesses, it's a silent killer. Ever wonder why your local coffee shop insists on a $10 minimum for card payments? That 2% fee might turn their morning brew into a loss. Multiply that by thousands of transactions a month, and suddenly that small fee is the difference between keeping the lights on or shutting down. This squeeze forces small shops to raise prices, push customers toward cash, or simply close, handing more power to big corporations who negotiate better deals or avoid fees altogether. Meanwhile, the push toward a cashless society hands credit card giants even more control. The less cash people carry, the more data and fees flow into these companies' coffers, creating a digital moat around their empire. But fees are just the tip of the iceberg. Credit card debt fuels consumer spending, and consumer spending drives roughly 70% of the US economy. When Americans max out their cards just to keep buying, the economy looks healthier than it really is. Retail sales boom, stock markets soar, GDP grows, but it's all propped up by borrowed money. This borrowed spending creates a dangerous illusion. The economy seems strong, but it's a house built on plastic, not cash. Look internationally, and the picture's the same. Countries with lose your credit laws often have skyrocketing credit card debt, making their economies vulnerable to sudden shocks like an earthquake waiting to happen. History isn't kind here. In the 1920s, department stores offered installment buying, a tempting buy now pay later dream. But when the Great Depression hit, millions learned a harsh truth. They didn't own their purchases, the banks did. Today, the same psychological trick, instant gratification with delayed pain, is baked into credit cards everywhere. The stakes have only grown. It's not just personal debt anymore, it's a global economic ticking time bomb. Here's the uncomfortable truth. The entire economy is addicted to consumer credit. If people stopped using credit cards tomorrow, the ripple effect would be instant. Retailers collapse, banks lose billions, credit networks takes a hit that shakes global confidence. And history shows that when the credit engine stalls, it ends in recessions, layoffs, and political panic. Even responsible users aren't immune. Their spending data fuels the same machine. It's the same playbook as 2008. A few bad borrowers weren't the problem. The system was. So the question isn't whether you should cancel your credit card. It's this. When the system relies on you staying in debt to survive, who's really trapped? You or all of us?